everybody, and welcome to another episode of the Olympus Wealth Strategies Podcast, where we help you take your finances to great heights. I am very pleased to have a special guest on the podcast. The CEO of StepStone Private Wealth, Bob Long, has joined us to share some insights today and provide a lot of value and understanding of ultimately investing in the private market space. So, Bob, thank you so much for joining us, and happy to have you.
My pleasure.
I'm not going to be able to explain it as well as you. If you can kind of give us a kind of quick background on who you are and kind of a little bit of a flavor, both professionally and personally.
Sure. I'm the founder and CEO of StepStone Private Wealth. We created this business about 6 years ago, myself and 3 other founders. I have a long background in the public and private markets. I began my career as a securities lawyer, then moved into the private equity business. Took a company public brilliantly in June of 2007, for those who remember what great timing that was. A listed fund of private equity funds, which was to some extent a precursor of this business. Then went on from there to run a U.S. publicly traded company in the business development space, and then founded StepStone Private Wealth. So I've done a variety of things. Some just say I can't keep a job. I like to say that I'm an entrepreneur.
Hey, if you're not constantly engaged and feeling like there's a new challenge, it's time for a different opportunity.
Yes, it is.
Well, Bob, maybe you can just at a high level tell us, who is StepStone?
Yeah. StepStone is one of, if not the largest allocators to the private markets globally. We are a truly global firm. There are 1,100 of us operating from 26 offices in 16 countries. We do only private markets and all the private markets. So think about alternatives as a broad set and private markets as a subset. So private equity, private credit, private real estate, private infrastructure. For this purpose, we'll include venture capital as a subset of private equity. We don't do hedge funds or commodities. So we do all the private markets, private equity, credit, real estate, infrastructure, and only the private markets, and we do those on a global basis. We manage about 90% of our $700 billion of assets for institutional investors and a modest portion for individual investors. Most of those institutions are well-known and sophisticated firms like the United Nations Pension Plan or various state pension plans and insurance companies. And we started the private wealth business really to deliver that same investment content that StepStone provides for institutions to individuals.
Yeah, and it seems like, Bob, obviously with the side of the table that I sit on and the people that I serve being on the retail side, surely has been a democratization, for kind of an overused word there, for private markets to be able to incorporate those in individuals' portfolios as opposed to just the sovereign nations or very large institutions and endowments.
It has been. In fact, we like to take it a step further. We tend to think we are democratized. We're now institutionalizing the democratization. So it gets really to why we formed StepStone Private Wealth. It was around 2 principles: to deliver the same investment content that StepStone has been delivering to institutions for a long time. Or a short way today to do that is your clients are getting into the same deals at the same price, at the same time as these large sophisticated institutions. And the second principle is to try to be as investor-centric as we possibly can. And that's sort of a generalization. We break that into 3 components. Our desire is to be the most efficient, which is a nice way for inexpensive, convenient, easy to do business, and transparent, no surprises. And in our world, no surprises is really important, we find, to build trust. We talk a lot about building trust share with financial advisors and with end clients. It's really important to be transparent, and I think that's been one of our big strengths.
I would completely agree, and especially when you talk about ease of use, whether that be versus the traditional drawdown funds being more of the evergreen, or even I know StepStone has a large presence in the interval fund space. You certainly have made it easy on us advisors to deliver that product to our clients. So that's been a big plus for me and the team. Bob, maybe you can talk a little bit more about. You mentioned, obviously continually growing in your career. Why did you form StepStone Private Wealth?
It was really around those we recognized sort of 2018, 2019 time period that there was an opportunity that technology had developed to allow us to deliver that institutional investment content to individuals in these convenient formats. You mentioned an interval fund. Interval fund and tender funds are slightly different, not worth going into on a 20-minute podcast. But these evergreen funds allow individuals to get into the private markets immediately and be fully allocated, and frankly have most of the convenience, not all, most of the convenience of a mutual fund. So when both the technology to evaluate deals and predict liquidity and all these sort of back-end things you need to do to create mutual funds for private assets, when those had advanced adequately, we jumped on the opportunity. We weren't alone. We were one of the leaders, and we were a bit earlier than most. But we recognized that opportunity that we could finally deliver on the promise of private markets in a practical way for individuals. And when that became clear in 2019, we jumped on it, and we've been thrilled. The market's embraced our approach. We're about $10 billion now of AUM. We actually had a recent celebration of that, and we're one of the fastest growing firms in the market, I believe, because we've embraced that convenient, efficient, transparent approach.
I completely agree, and it's been a big change versus, like I mentioned earlier, the traditional drawdown funds that you get the capital calls, and it's much more labor intensive and not as easy from the advisor standpoint, being able to deliver that to their clients as opposed to being able to invest just on day one through those different forms. Bob, obviously this conversation is really centered around private markets and your firm, but why should investors care about private markets?
It's a good question, probably the most important question we're going to talk about today. I'll break that down into two sides, offense and defense, right, from an offensive perspective, because that's where the growth is. The average private company is growing revenue at least 4% faster than the typical public company. Diversification, improving your downside protection. There's an asymmetric risk reward or upside downside element to the private markets. We'll speak specifically to private equity. Private equity captures 115% or more of the upside in the public markets and only participates in about 60% of the downside. So 115% of the upside, 60% of the downside on average across cycles. Of course, actual results may vary, and path does not necessarily prologue, and you should evaluate any individual product on its merits. But that's been the history according to our research. So that's pretty doggone important. And when you think, to put a number on it, the historical return premium across, well, I'll quote a statistic. So one of our good competitors called Cliffwater did a study where they evaluated not hypothetical results, but actual results from about 90 U.S. large pension plans. They have to disclose their results for government regulatory reasons. And so these are actual investors, and they'd invested substantial amounts in private equity over a long period of time. And their results showed about 4%, 400 basis points annual compounded return benefit from being in private equity versus public equity. And so that's pretty material when you compound. And I know you preach to your clients the benefits of compounding gains and saving for their long-term goals and retirements. 400 basis points, 4%, pretty meaningful. So that's offense. Get the 4%. Defense. Well, this is a statistic that might surprise many people. In the United States, with respect to companies of size and scale, 100 million of revenue or more, not your corner grocery store or my personal LLC. We're talking about investable businesses, 100 million of revenue or more, 87% are private. 87% are private. And there are only about 2,800 public companies today. That's down by about half over the last 20 years. You can thank Sarbanes-Oxley, a lot of other factors, but the net result is there are fewer and fewer public companies in comparison to private companies. And further, when companies do go public, they go public much later in their life cycle. So companies like Microsoft and Amazon went public early in their lives, and there was much of the upside left that a public investor willing to invest in them, of course, at that stage, you had to be willing to invest. They've seen massive growth, compounding growth for decades. And today, when companies go public, it's when they're 10 or 12 years old and they have $1 billion of revenue. And so many of those high growth companies still do well, but they don't achieve the extraordinary growth that was achieved while the companies were private. So to say differently, the public gets in on the game much later in the game today than they used to. So that's really big. And so much of the growth in the public markets stays private. There are about 1,300 unicorns. You probably know that term. Private companies with $1 billion or more of revenue or $1 billion or more of valuation. And one of the hottest merger and acquisition and IPO markets ever, maybe the hottest, 2021, only about 200 of those went public or were sold. So that left the vast majority, again, still private. All of which is to say, it's hard. A lot of the growth in the economy takes place while companies are private. And it seems to me that those trends are not slowing down. In fact, if anything, they're accelerating. That's why you need to think about the private markets. You need to consider them, whether you consider our funds or the many other good funds, including others offered by Olympus. You need to at least be thinking about it and asking your question, why not be in the private markets?
Well, and just like you said right there, Bob, 87% of companies that have over $100 million of revenue in America are private. And if you think about accessing the investable universe and how IPOs, like you just articulated, are consistently trending down, being able to truly invest in America, it seems like it's becoming more and more prevalent that the way to be able to access that is through private markets.
That's 100% true.
Well, in your career, obviously you've had a very storied career from the different places you've been.
That's a good word. That implies some ups and some downs, because I've definitely had both of those.
Well, we won't talk about the downs on this podcast.
All right, fair.
But how have the markets changed? You kind of alluded to that from maybe a little bit with slowing down of IPOs. But how have markets changed during your 30-plus year career, but particularly with respect to finding growth?
Yeah. A number of things have changed. We talked about the fact so much of the growth takes place in the private stage of a company's life. I think we covered that. The second thing is, my professors in grad school, and this is in the 80s, revealing my age, we were taught markets were going to get more and more efficient. And we've seen things like trading commissions come down and more transparency in the public markets. But in some ways, the public markets haven't gotten more efficient. I mean, had we talked about the meme stock phenomenon in my corporate finance classes, economics classes in the 80s, my professors would have said, no, there's no way a company that isn't worth $2 a share is going to trade at $50 a share because some people think it's cool. I mean, the concept of meme stocks and the idea that a guy named Roaring Kitty can jerk markets around, they would have said, no, markets are too efficient. That might happen for a day or an hour, but efficient markets will weed that out. And it just hasn't to be true. And in fact, public markets are to some extent driven by memes, media, and momentum. And that's not healthy for anybody. I'll use a more recent example than the Roaring Kitty and GameStop. January of this year, I think it was Monday, January 28th, if my memory serves. We all woke up to learn a word we never heard, DeepSeek. And so overnight, there'd been a press release or an announcement. A company called DeepSeek was going to change AI, and $1 trillion of market cap had been wiped out before markets opened. $1 trillion. For a company,
that's just an unfathomable number.
Yeah, had evaporated before anybody had time to validate, is this company real? Is this fake news? And it wasn't. But the point is, markets, the public markets can be at times influenced by this memes media momentum, whereas private markets are valued more on, they're not perfect, valued more on fundamentals. That's a really big change. I would have thought, again, when I was in school 40 years ago, that these would have gotten more converged, but in fact, they've arguably diverged. The other thing is the private markets are just so much deeper. I've had the honor of serving as the CEO of a publicly traded company twice in my career, and that was what you sought. If you got out of school in grad school in 1987, as I did, that's what you wanted to do. Being a public company CEO was really an honor and something to seek out. But today, not so much. People don't want to be subject to quarterly earnings pressure. They don't want to be subject to the media scrutiny. But 30 years ago, even 20 years ago, if you wanted to build an enterprise of size and scale, you had to access the public markets, no matter how publicity shy you were, or no matter what your business plan was. The private markets weren't deep enough. So I'll give you an example. What could be more capital intensive than building rocket ships? Hard to think of much.
Oh,
right?
gosh.
Hard to think of much. Maybe public utilities. Okay. Not much. But yet the leading rocket ship company is private, has raised over a dozen rounds at increasing valuations. That company is doing a private tender offer to give its employees liquidity at $1.25 billion right now. And of course, I'm talking about SpaceX, which happens to be a meaningful position in our venture and growth fund called Spring. But think about that. 20 years ago, you couldn't have built a SpaceX just relying on private capital. There wasn't enough. But today there is, and more. And it's not clear that company will ever go public. Not clear that it will ever go public. So that's a really big difference. Private markets are deeper. Public markets have not necessarily gotten more efficient. So that leads more companies to stay private longer.
That's so intriguing, Bob. And I think we'll continue to see that narrative only further and deepen as years go by. You mentioned something right there towards the end. You mentioned your fund Spring.
Yes.
Which for all of our listeners out there, that is, like Bob mentioned earlier, out of the private markets, there's private equity, and a subset of that is venture capital and growth. And so talking about that subset, Bob, where does venture capital and growth equity fit into a portfolio?
It's harder and harder to find high quality growth in the public markets, particularly small cap growth. Public markets, you have some large growth oriented stocks for sure, the Mag 7 and others, but it's harder for portfolio managers like yourself to find growth, and venture capital and growth equity can provide that. Of course, they do come in a private company wrapper. Just as a couple of stats, the Russell 2000, half those companies aren't even profitable, and this is a little harsh, but it's not original to me. Those are mainly the companies private equity didn't want to buy. And so if you want growth, we've talked about the high growth in the private markets, you've really got to think about it. You got to think about venture capital and growth, and then you get into the question of how do you access that? And I'll go on and hit that then. So we haven't spent a lot of time in this podcast talking about the challenges of accessing private equity, but they're probably well known to your audience, right? It's unpredictable capital calls and distributions. The investments are hard to diligence because information is proprietary and opaque, as opposed to public companies where by law it has to be made available equally to everyone. It's hard to get into the best funds if you want to. First of all, it's relationship driven. And then secondly, the check size you have to write would be out of reach for most individual investors. And then once you do invest, you experience something called a J curve, where you see a negative cash flow and sometimes a decline in value for 3 or 4 years while the fund is making investments. And then if they're successful, you see cash flow back in appreciation and value, ultimately to an attractive return, but a trough, which we call a J curve. So all that applies to private equity generally, but for venture, it frankly compounds all the negatives. So first of all, it's the hardest to diligence, the hardest to get information. They're very secretive. And you're often talking about companies that are an N of one. So just understanding what the comps are is difficult. The duration of venture assets is even longer than private equity. So you'd have a longer J curve. Access, being able to actually access. I mean, we all know who Sequoia is and Andreessen Horowitz, but for most individuals, impossible to access their funds. And then liquidity in that market is also extremely limited. So we did design an evergreen fund that's essentially a mutual fund for private assets. From a legal perspective, it walks and talks like a mutual fund that invests in venture and growth. It's called Spring. It's available to qualified clients, those with 2.2 million of investable assets. And it allows you to come into a fully diversified, mature portfolio of venture capital and growth equity on a monthly basis. And then we provide a portion, 2.5% per quarter, liquidity in that fund on a quarterly basis. Importantly, that's not of your investment, but that's of the fund. So you can get into the fund monthly, you can exit the fund quarterly. Subject to these limits, we put out a net asset value monthly. And so this is a way for individual investors and smaller institutions. We have a lot of interest from smaller institutions, small endowments, your local foundation, community foundation, or maybe private school endowment that has a long-term investment horizon and would love to invest some portion in the high growth potential of venture capital growth equity. This is a particularly interesting way for those individuals. And I wouldn't recommend it for really small investors who need a lot of liquidity. But for larger investors, it's a pretty interesting way to look at growth. And of course, you should read the prospectus and talk to your financial advisor and consider the risks. We've had good results, but past is not necessarily prologue, and there's no promise those results will continue. But we do believe we have meaningful competitive advantages. I should say, since I've gone deep on Spring, one question when I'm in an interactive format, which we're not here today with your audience, that I get is, tell me more about these companies. So to be clear, so it's companies like SpaceX, Anduril. If you don't know Anduril, you should Google it. It's the SpaceX of the defense industry, hopefully going to dramatically improve our nation's safety and security by improving our defense procurement process. XAI, Chime, a lot of fintech, and then a lot of other interesting high growth companies like the farmer's dog. Those of you who know, you spoil your dog and you overspend, we really appreciate it. Farmer's Dog is one of our portfolio companies.
There's a bag in the fridge that my wife just bought.
And I won't ask you, when I'm face to face, I'll say, if your wife had to choose you over the dog, I get people to raise their hands. We will not do that here. It always comes out.
Thank you. That might have been too tough of a pill to swallow on this episode.
Yeah. It always works though. These are not garage startups, right? We at StepStone, we invest in early stage, like pre-revenue companies. We don't do that for individual investors, right? These are companies that have at least 10 million of revenue. On average, I should use median, SpaceX would skew the average. Median, the typical company's 50 or 60 million of revenue. These are companies that are beyond, does the technology work? Is there a market? Can I execute as a management team? These are on the can we scale it stage. And that's why the target returns, which you'll have to ask John about, I won't speak to, are where they are, because these are mid and late stage venture capital. And then growth equity are companies that are further in their growth trajectory, but not as fast as venture capital, and frankly a little safer, but with lower return potential. So it's 70% venture, late and mid-stage venture, 30% growth equity. So that's what we're doing with Spring. It's really designed for individuals seeking to get growth in their portfolio or disappointed with what their options are in the public markets.
Like you mentioned, the public markets are now delivering companies that are later in stage and maybe not as much potential appreciation and upside as companies like you'd referenced earlier that really kind of came to light much earlier on in their journey. Let me let me kind of leave you with this question, kind of a burning question that I've got for your 30 plus year career.
Yeah.
All the stops you've made, whether it's, public companies or private companies. I just have to ask you, what is your best investment?
I'm going to give you an off the run answer. My best investment is not in a for-profit company. It turns out that in the United States, it costs $25,000 to $35,000 to adopt a child. And there's so many families who are ready, willing, and able. They've been qualified. They've been matched with a child. And yet coming up with $25,000 or $35,000 is a lot of money for them. Plus, they have to rear the child. And so I work with an organization called Gift of Adoption, the Gift of Adoption Fund. And for $5,000, our average grant is $5,000. We fund that last mile. We allow families to complete an adoption. And so the way we think about it is $5,000 makes a family, and I consider that an infinite IRR.
That's truly special, Bob. I know we all probably know people who have felt the calling to adopt, and I think one thing that consistently comes up is the ability to afford it, and that's a big blessing that you and others bestow upon other families to make them whole.
It's a great opportunity. It's an honor and a privilege.
Well, Bob, thank you so much for obviously taking the time to come on the Olympus podcast and sharing your insights and kind of an understanding of obviously who StepStone is and their specialties. And very blessed to have you. And thank you so much for being a great partner.
Thank you.
All opinions expressed on the podcast by the host and guests are solely their own opinions and do not reflect the opinion of Olympus Wealth Strategies or Uptick Partners, a registered investment advisor. This podcast is for educational purposes only and is not legal advice and should not be relied upon as a basis for any decisions. The investments discussed on this podcast may not be suitable for all investors and involve risks that should be carefully considered. Listeners are encouraged to consult with a qualified financial advisor before making any investment decisions. Certain investments may require specific investor qualifications, which not all individuals may meet. Any funds or companies discussed are not a recommendation or endorsement. Guests in the podcast might be actual clients, but are not compensated to be on the show, and their experiences are not representative of all relationships, which might differ substantially.